Good morning, everyone. Today, we're going to delve into the snowball effect, deconstructing the physics behind Warren Buffett's incredible wealth machine. As Buffett famously said, life is like a snowball. The important thing is finding wet snow and a really long hill. We'll explore the core variables of compounding, which we can think of as the essential ingredients of this snowball. First, we have capital allocation, which represents the wet snow, the quality of the businesses you choose to invest in. Next, there's time, which is the hill, the duration over which your investments can compound. And finally, behavioral discipline, the physics, the consistent, rational approach that keeps the snowball rolling. Let's start with the $81 billion lesson, which clearly illustrates that the primary variable in wealth accumulation is time. Consider this thought experiment: if Buffett had started at age 30 with $25,000, earned his legendary 22% annual returns, but then decided to retire at 60 to play golf, his net worth today would only be about $11.9 million. While a great sum, it's a fraction of his actual wealth. This demonstrates that approximately 99% of his wealth was accumulated after his 50th birthday. At 30, he had about $1 million. By 60, it was around $3.8 billion. But by 90, it surged to $84.5 billion. This exponential growth underscores the critical role of compounding over long periods. Now, let's talk about the wet snow itself, captured by the adage, price is what you pay, value is what you get. This slide contrasts two distinct approaches to the market: the stock operator and the business owner. The stock operator focuses on price action, momentum, charts, and short-term predictions. Their game is about timing the market. In contrast, the business owner's focus is on intrinsic value, cash flow, management quality, and genuine ownership. They look at companies as businesses, not just ticker symbols. As John Maynard Keynes put it, "I would rather be vaguely right than precisely wrong." This highlights the importance of understanding underlying value rather than chasing speculative price movements. To effectively identify that wet snow, we need a selection checklist, guided by 4 tenets of rationality. First, the business tenets: is the business simple and understandable? Does it have a consistent operating history? And, importantly, does it possess favorable long-term prospects, ideally a franchise, rather than a commodity business? Second, the management tenets: does management engage in rational capital allocation? Are they candid and transparent with shareholders? And do they resist the institutional imperative, which often leads to irrational corporate behavior? Third, the financial tenets: do they focus on return on equity ROE rather than just earnings per share EPS? Can we calculate their owner earnings accurately? And do they maintain high profit margins? Finally, the market tenets: do we insist on a margin of safety? And are we buying at a significant discount to the intrinsic value we've identified? This holistic approach ensures we're investing in solid businesses at sensible prices. A unique aspect of Berkshire Hathaway's wet snow is its hidden booster insurance float and leverage. This is how it works: policyholders pay premiums, which Berkshire holds as float capital held before claims are due. This float, currently over $171 billion, isn't just sitting there, it's invested for Berkshire's benefit. This provides a significant advantage: it acts as 1.7 times leverage, but crucially, at zero cost. Unlike debt, float requires no interest payments. This amplifies Berkshire's return on equity to 10 to 12% from underlying asset returns that might otherwise be 6 to 7%. It's a powerful, cost-free source of capital that accelerates their compounding. The knowledge advantage is another critical component, and Buffett often refers to reading as the best addiction. He spends 80% of his day reading and thinking, emphasizing that knowledge builds up like compound interest. Take the example of Coca-Cola in 1988. Reading annual reports during the New Coke crisis revealed its enduring value. Similarly, his investment in Japanese trading houses came from discovering undervalued conglomerates by meticulously reading public filings that most Western investors ignored. The goal here is to build a well-defined circle of competence, knowing what you understand deeply and sticking within those boundaries. Mastering Mr. Market is fundamental to behavioral discipline. Benjamin Graham's allegory describes the market as a moody partner, sometimes greedy, leading to high prices, and sometimes fearful, leading to low prices. The key takeaway is that the market is a servant, not a master. It exists to provide you with prices, not wisdom. Our strategy, as Buffett advises, is to be fearful when others are greedy, and greedy when others are fearful. Volatility, often seen as a risk, is actually the opportunity to buy that wet snow, high-quality assets at a significant discount when fear grips others. Let's look at the $1 million bet, a powerful illustration of simplicity versus sophistication. Buffett famously wagered that a low-cost passive index fund would outperform a basket of elite hedge funds over a decade. The results are stark. The S&P 500 index fund returned 159%, while the basket of 5 hedge funds managed only 57%. The lesson here is clear: high IQs and complex strategies rarely beat low costs and simple averages. The cost of fees and complexity often erodes returns, proving that a straightforward, broad market approach can be far more effective for most investors. Our Style Wars slide compares the tortoise versus the hare in an inflationary period. During 2022, we saw distinct performances. ARKK, representing disruptive growth strategies, was down 20%. In contrast, Berkshire Hathaway, focused on value, cash flow, and pricing power, was up 7%. This highlights that different environments favor different snowballs. Rising interest rates, for instance, punish long-duration growth stocks whose profits are far in the future. Valuation acts as an anchor for a portfolio, especially when liquidity dries up. This shows the cyclical nature of investment styles and the enduring power of sound valuation principles. Now, let's consider the law of large numbers, a reality check for even the greatest investors. Berkshire Hathaway's compounded annual growth rate, or CAGR, is now converging with that of the S&P 500, at roughly 10.5% versus 11.1%. The sheer size of Berkshire is a significant anchor. With a cash pile exceeding $348 billion, it requires elephant-sized acquisitions to meaningfully move the needle. Berkshire has shifted from being primarily a stock-picking machine to a shadow central bank, often providing liquidity during global crises. Consequently, its Sharpe ratio, a measure of risk-adjusted returns, is now statistically similar to the broader market, indicating the challenges of outperformance at such an immense scale. The behavioral edge is perhaps one of the most critical aspects, embodied by the concept of the inner scorecard. Buffett poses a thought-provoking question: would you rather be the world's greatest lover, but have everyone think you're the world's worst? Or would you rather be the world's worst lover but have everyone think you're the world's greatest? The definition here is about living by your own standards rather than seeking external validation. This autonomy allows an investor to hold unpopular positions, like sitting on cash during a raging bull market, without emotional distress. It's about having the conviction to stick to your principles, irrespective of what the crowd is doing. We can see this behavioral edge and conviction in action through several case studies in conviction. First, American Express in the 1960s during the salad oil scandal. The stock collapsed, but Buffett confirmed the brand and underlying business were intact. He bought 5% of the company at a deep discount. Then, Coca-Cola in 1988, after the 1987 crash and the New Coke debacle. Buffett recognized an enduring global franchise with immense pricing power and invested $1 billion. More recently, Apple, starting in 2016. He identified it not as a tech bet, but as a consumer behavior bet, recognizing high switching costs and ecosystem stickiness. These examples underscore his belief that time is the friend of the wonderful business, the enemy of the mediocre. To manage your investments wisely, consider the too hard pile and the 20-slot rule. The rule suggests acting as if you have a lifetime decision card with just 20 punches. If you only get 20 investments in a lifetime, you will think very carefully about each one, ensuring only your best ideas make it through. This is closely tied to the circle of competence. You don't need to be an expert on everything. You just need to know where the perimeter of your knowledge ends. As Buffett warns, risk comes from not knowing what you are doing. Stick to what you understand deeply, and put everything else in the too hard pile. Finally, we come to the ultimate snowball, which, according to Warren Buffett, is relationships. He shares a profound insight: when you get to my age, you'll really measure your success in life by how many of the people you want to have love you actually do love you. He adds that reputation takes 20 years to build and 5 minutes to ruin, and the only way to get love is to be lovable. This reminds us that while financial wealth is important, true success is often measured by the quality of our human connections and the legacy we build beyond just money. So, to summarize how to build your own financial snowball: first, find wet snow, identify simple, high-quality businesses with strong fundamentals. Second, find a long hill, start early and never interrupt the powerful process of compounding. Third, ignore the weather, remember that Mr. Market is a servant offering prices, not a guide for your decisions. Fourth, keep friction low, avoid high fees and unnecessary leverage that can erode your returns. And fifth, watch the scoreboard, measure success not just by market performance, but by your inner scorecard and adherence to your principles. As the old proverb goes, someone's sitting in the shade today because someone planted a tree a long time ago. Thank you.